let's get started. Will Woodall, Mike Rarey from CAP STRAT. Week of August 15th, live show number 2. We've got some new charts, talk about the same stuff. Bear market rally continues. Crazy week last week. A lot of new information came to light, so we're going to talk through that. The market continues to rally in the face of some declining expectations, and we'll talk more about that. And with that, we'll throw up the grid for returns. So we'll start with fixed income. Rough week for fixed income.
Yep. Yeah, negative returns for high quality bonds, generally seeing interest rates rising, particularly the intermediate and longer term portion of the US Treasury yield curve. But still, on a quarter to date basis, seeing positive returns. So quarter to date here being July 1st through August 12th. And then high yield bonds and emerging market bonds, which are, plus or credit type sectors, continuing to rally, credit spreads tightening as equity markets rally.
Yeah. Still noting though, Treasury still down over 8.5% year to date. And then over on the right hand side, we have a price yield regime.
Yep.
Indicator. Can you explain to the viewers what that is, how we use it?
Yeah, so we've talked a lot, and most viewers are probably familiar with inflation, liquidity, economic growth, and recession as our 4 macro factors. But we take everything that those macro factors say, asset class by asset class, and we run them through the lens of the price factor. And so every single asset class in fixed income, we use yield regimes. So our yields low and rising, high and falling, or low and falling. And these indicate different return environments and future expected returns for various asset classes. So as you can see over there to the right, we've color-coded the regime, so you know what regime we're in, and color-coded it to see is it a positive or a negative. So US Treasuries, for example, we are in a high and rising yield regime, and that's typically the second best yield regime. High is great because you get a really good yield and you can compound that and reinvest it. And the next best yield regime is high and falling yields, because when bond yields fall, bond prices rise. We're not there yet, but we think we'll be there soon based on inflation.
All right, so green is high, or green is positive.
Yep.
Rising, the color blue there.
Yep. And it does change based on the asset class. So you'll see high and rising yields are a net positive for the high quality bond asset classes. High and rising are actually a net negative for the credit sectors, high yield bonds, EM bonds. That's why you'll see red there.
Cool. Let's move on to equities, alts first, sorry. We'll look at alts. Another big week across the board. We've seen a reinflation of commodity prices and energy.
Yep. It's a very interesting dynamic that when commodity prices were going down, that was great because it brought down inflation expectations, which allowed the market to rally, which reinvigorated economic growth expectations, which caused commodity prices to go back up.
Right.
So it's sort of caught in this flywheel, if you will. But commodities having a big week, month to date positive, quarter to date positive across the board, particularly energy. Energy up 6% last week, up almost 78% year to date.
Yeah, absolutely.
Yeah.
Okay, let's move on to equities.
So yeah, equity market, a positive week pretty much across the board. We've seen a continuation since mid-June, the near-term bottom in U.S. equity markets, seeing a rally since then, with small caps generally outperforming large caps. Small caps are more insulated from what's going on outside of the U.S., more insulated from currency translation risk in terms of earnings, given that the dollar's been strengthening. So having a really, really strong quarter, but you see still down, still in technical correction territory, large growth stocks just exiting bear market territory on the year-to-date basis.
Yeah, it was a good, a lot of narratives or headlines on bear market's over.
Yeah.
And the new bull market has begun. So that's a lot of labels, a lot of talk. So maybe just talk about what that actually means.
Yeah. Well, so a bear market means the equity index is down 20% or more from its high, And for that to be over, it would have to come back to where it was before the drawdown started. So, large growth stocks are they're still down 15.8% year to date. So they're still firmly in a bear market territory. And you can apply a lot of different labels on these things. And, depending on when you look at returns, it can be a little bit misleading, trailing return wise. For us, that's why we focus on price regimes. So that's all the way out to the right there. You can see large cap equities, they're all high and falling still. All of these equity asset classes are still above their long-term trend, and the prices are still going down on a longer-term basis. If you focus on that one-year column, for example, you can see pretty much on a price return basis, these are total returns shown here, but on a price return basis, all of these equity asset classes have a negative price return over the one-year basis, implying they would be falling. So that's what really matters in terms of our framework. If we go from high and falling to low and rising, that would be meaningful for us.
Right.
And in large growth stocks, for example, we're pretty far away from that. We're still high and we're still falling. So,
yeah. And so all of the talk about, is this a new bull market? Those are just narratives. And in terms of where we see the puck heading, this is just a brief reprieve in the continued deceleration.
Yep.
So let's move on to inflation here, and we did get some CPI data, so we're going to talk through some of that. If we can throw that inflation shock chart back up here, look at the continued deceleration that we're going to be witnessing over the coming months as our forecast would sort of lay out here. But talk about the inflation shock and the difference between headline and core.
Yep. Yeah, the July inflation data showed headline inflation 8.5% year over year. So that includes food and energy prices. That is lower than the 9.1% recorded in June. So more evidence, this is something we've been talking about for quite some time. As those food and energy prices had started to come down since mid-June, that should eventually feed through to lower year over year numbers in terms of headline inflation. And that's the whole reason why we've been saying for so long we're on the cusp of a regime shift, inflation going from high and rising to high and falling. So we saw that. So that was good news. We saw that the inflation print came in cooler than expected. That's the first time in a long time. Inflation's been surprising to the hot side for quite some time. And then on the core inflation side, 5.9% year over year, that's unchanged from the June print. So just sort of moving sideways.
And the Fed cares more about core inflation.
Right. They typically care more about core. They are very cognizant of headline because headline actually has a bigger impact on consumers' inflation expectations,
right,
which is something they're worried about. They don't want inflation expectations to become unanchored. So they're trying to manage both, even though they really can only indirectly impact both of them and really can't impact headline all that much.
Mm-hmm. Yeah. So speaking of headlines, there was a headline last week about inflation there was no inflation last month.
Right.
And so if we throw the chart up on the month over month inflation stats, we can see actually there was zero increase in inflation month over month.
Yes. It's interesting that this has become highly politicized. I guess not surprisingly so, given midterms. And this is sort of public enemy number one is inflation right now. But so was there inflation in July? Of course, there was inflation in July. The prices of certain things went up. I believe what that statement is referring to is the fact that on a month-over-month basis, headline CPI was flat. Mm-hmm. Prices in aggregate did not go up from June to July.
Right.
And that was because food prices did go up, there's your inflation, but they were offset by falling energy prices. We've seen gas prices come down quite a bit here. We've released a lot of oil from the Strategic Petroleum Reserve. There's definitely been demand destruction, less driving, folks deciding to drive less, take fewer trips because gas prices are so expensive. So we see that in headline, zero month over month. And then we go down into core, and there's clearly still inflation.
Right.
There was some softness in apparel, some softness in transportation services, which is really just a pass-through from lower fuel prices, gasoline prices. But the most alarming thing in the core basket was shelter.
Right.
If you look at the weights, that's 32% of the entire headline CPI basket is shelter, and that was still up 0.6% month over month. That is far too hot. That is far too hot. So really, when you look at this, we think this reinforces high and falling. Plenty of reason to think we're falling. Plenty of reason to think we're going to be high for a long time in terms of inflation.
Right.
Yeah.
So let's look at the forecast here. You talk a little bit about, because the Fed did come out, several Fed members did come out and speak about the path of interest rates in the face of this inflation. And there's a lot of, I think, developing divergence in the rate of change of the deceleration.
Yep.
How fast will it decel or not? And I think we're starting to see a lot of forecasts that say it's going to fall a lot slower than people think.
Yep. Yeah, looking at our forecast for inflation, you can see that dashed blue line on the chart is what we think, where we think inflation is likely to head. So this is year-over-year headline, and you start to sort of take it month by month and talk about what we're going to look at here and where could the surprises be. And the next 2 months, it's actually likely that headline and core CPI are going to plateau through August and September. And the reason for that is just how the math works out. So
Go back to this graph here.
Yeah. So basically, when you look at the year-over-year number, we have the 12 trailing months here.
Right.
So we're going to be tacking another month on the front end, and then we're going to lose a month off the back end. And the back 2 months were really soft inflation numbers. So you look at the headline numbers in August 21 and September 2021, real soft, and the core numbers very soft as well. And we're likely going to add months to the front end of this that are at or above what's going to fall off.
Right.
So that basically means inflation is going to move sideways for the next 2 months. From there, that's when, based on the evidence of slowing economic growth that we've seen, that's when it's going to start to fall much more quickly. Once we get to October through about March, we should be coming down at a reasonable rate. And if this plays out like past economic downturns, which it probably won't because we're in a monetary inflation and we weren't in that previously in 2008, for example. But if it were to play out like a traditional economic downturn, from there inflation would come down real quick, maybe even go negative month over month as we get into late this year, early next year. That's where the divergence comes from. If you run what we're seeing here through traditional statistical models that are using the relationships that existed in 2008 and 2000, recessions that were not in monetary inflations, you would expect to see inflation come down hard. But there's plenty of evidence that this time is different. We are in a monetary inflation, and we just talked about shelter. Shelter follows home prices with a 12 to 18 month lag. Home prices have just stopped going up. So they're going to be contributing to core CPI for a long time in terms of rents, continuing to move higher at a pretty high clip. So that's where the divergence comes in, that sort of path, that sort of middle portion of the next 12-month forecast. And then the last portion of the 12-month forecast, that's when everybody's pretty much in agreement that it's going to come down pretty quick, because now you think about the 12-month window and you look at the year-over-year and the base effects. You start taking out these huge hot inflation numbers from March, April, May of this year. That number is going to come down hard.
Right. Yeah. So it'll be interesting to see how it plays out. What the path, though, is really what the Fed looks at, right? So they're interested in how fast is it coming down. Some of the Fed comments, and we throw some of these up here on the screen, in terms of where the Fed needs to land the federal funds rate in order to defeat inflation.
Yep.
That's going to become very volatile in the coming months.
Yeah, you think about the last month and a half or so. A lot of sort of soft landing type vibes in the market, right?
Yep.
You get job openings come down dramatically while non-farm payrolls are increasing. Inflation finally surprises on the cool side, And the Fed and the markets is running away with it, bringing down long-term inflation expectations. Equity markets are rallying. And the Fed's sitting here and saying, we did all this hard work to raise the Fed funds rate, to tighten financial conditions so we could destroy inflation. And the market is getting super excited about 1 month of soft data, and the market will start to undo some of our hard work. The market can loosen financial conditions by itself, you know? And so the Fed, there's already been a push in terms of Fed speak to sort of throw cold water on the soft landing narrative, if you will, because the Fed doesn't want financial conditions to get too loose.
Right.
They literally do not want the equity market to be rallying this much. They do not want longer term interest rates to come down dramatically, or inflation expectations to come down sort of dramatically. They want financial conditions to be tight. So that's where you can start to parse through some of the Fed speak and see what they're trying to do here.
Yeah, I mean, and we really haven't really seen the full force of the balance sheet runoff begin yet.
Right.
Now is the time it's happening. The end of this month into September, you're going to really start to feel the impact of that. So,
Yep. Yeah. So going through just a couple of quotes, these, you know, if you've been listening to Fed speak for as long as we have, this is totally different from what you would have heard in past cycles.
absolutely.
Totally different. Prior Fed, if we got any type of decent, better than expected, Goldilocks type economic data with an equity market rally, they would be coming out cheering on the market. And this is totally opposite. So this is Mary Daly. She's a non-voter. She's from San Francisco, historically pretty neutral, not a hawk or a dove. We don't want financial conditions to relax, quote unquote.
Pretty direct.
So if you look at financial conditions, which are an aggregate measure of, you know, where's the equity market at, where are interest rates at, where's the dollar at, are financial conditions loose or are they tight? They've actually loosened to levels similar to the first rate hike of this cycle in March. So the Fed's sitting here thinking, why are you undoing all our hard work? We want tight financial conditions because we want inflation to continue to come down.
Yeah.
And then you see it also from Neil Kashkari, who spoke after the strong jobs report, but before the CPI report. And he's talking about 3.9% Fed funds at the end of this year, 4.4% at the end of next year. Totally different from what the Fed funds futures curve is saying.
Yeah.
Which is suggesting peak rates basically end of this year and then cuts next year. And he historically is the most dovish Fed president from Minneapolis. So, you know, both of these, all this Fed speak is just reiterating the idea that, you know, the Fed needs to make sure they defeat inflation. They do not want financial conditions to loosen.
3.9% by the end of this year, and
Right.
the 10-year is under 3% right now.
Right.
So, and as we sit here today on August 15th, I think we're at the peak inversion between 2s, 10s. It's as low as it's been since this all started. So we're continuing to see, maybe for the viewers, explain the inversion of the 2s, 10s and how that translates into economic outlook.
Yeah, so the 2s, 10s yield spread is the second smartest economist in the room. An inversion, meaning the 2 years above the 10-year, has preceded every economic recession since World War II, basically, with a pretty good lead time. That's why it's a component of our recession forecast. Yield curve is very smart. And the reason why it's such a problem is because it slows the credit cycle dramatically. And so we're starting to see this. Not only is it the bond market saying that, hey, economic growth in the future is going to be lower than it is in the present because the 10-year yield is lower than the 2-year, but also anybody who basically takes in deposits or borrows money short and wants to lend it long now is paying more for what they borrow than the return they would get from what they lend. And so as a result, they stop lending, which slows the velocity of money, which eventually slows GDP growth. And we're starting to see this reflect in Fed survey data where banks are tightening lending standards. And that typically has pass-through effects to slowing economic growth. So We are at peak 2s, 10s inversions, and very quickly we'll be at 3-month 10-year inversion, and that is the smartest economist in the room. We'll probably be there in September once the Fed hikes again.
Right. Yeah.
Yeah.
And so, in terms of the Fed knowing this and the market reacting the way it's reacting, and we could talk a lot about what this rally, is it a real rally? Is it really based on economic rosiness, or is it just short covering and FOMO and stuff like that?
Yep.
But, if this is true, why does the Fed continue to push us towards recession?
Yeah. They are at the point where they understand they were so slow to raise interest rates post-COVID that the only way they are going to win the war, long-term war against inflation, is by sacrificing the U.S. economy. The only thing at this point, unfortunately, that is going to get inflation back consistently down in their 2.5% range is an economic contraction. And they realize that. And yeah, I mean, you can see some of the quotes from Neil Kashkari that we went through previously. A number of Fed spokesmen are on the record as saying they are willing to do that. They are willing to go through a recession in order to defeat inflation. Inflation is a tax on everyone. An increase in the unemployment rate only affects a small handful, of, relatively speaking, in the population. So it's just the lesser of two evils.
Yeah. Couple updates, liquidity. Throw that chart up. Nothing changed here. It's still looking to be the worst ever deceleration of liquidity in the history of liquidity.
Yep. And, having discussions with clients, I know back when this blue line was going straight up, there were a lot of ugly narratives in the world.
Yeah.
And I'm not going to say we cared less about them, but they were just less impactful, right? Because more money was being created at any other point in history.
Right.
And now we're in the exact opposite situation. All these things matter now because there is no safety net. There's no money being created to smooth over the economic weakness, the Fed hiking interest rates to an inverted yield curve. There's no safety net there. I mean, this is just looking at year-over-year change in money supply growth in the U.S. and what we're forecasting. We are in a situation right now where globally there are actually fewer U.S. dollars in existence today than there were a year ago.
Right.
Fewer U.S. dollars. And if dollars aren't being created and you actually want to create economic growth, that means the same dollars have to do more work. So you need velocity to just go up. And how are you going to get velocity to go up if the credit cycle is slowing?
Yeah, it's counter. Not going to happen.
What we've seen is just people monetizing financial assets so they can spend it in the real economy, but that can only last so long. Right?
Yeah.
So.
And we're sort of just starting the point of the deceleration where we're going to start to feel it. The next 6 to 9 months is really going to be substantial.
Yep.
So expectations are falling, but not probably fast enough.
Yeah. Well, economists just cannot reduce their expectations for real economic growth fast enough, basically is what we're showing. The blue line is consensus expectations for 2022 real GDP growth. It's at 0.25% now. Now, we had negative growth the first 2 quarters.
Right.
So that means a comeback here in the second half of the year.
Big comeback.
But in order to have a comeback, the data has to start coming in better than expected. And it has not. And we got more ugly reports today with Empire Manufacturing and the NHAB Home Builder Sentiment Survey. We need to see that red shaded area flip green.
Yeah, and we need 2 super strong quarters of growth in order to get to flat for the year.
Right. So this is what happens when you don't create money.
Yeah.
And it's happening on purpose.
Yeah. So translate that to economic forecasts. This is all consensus here.
Yes. Yeah. This is consensus. Those light blue bars. And in terms of regimes, we are now in low and falling or low and stable economic growth. We're clearly in low. Falling or rising, you can debate quarter by quarter, but we are clearly in a low economic growth environment looking at real GDP year over year. And that is historically the best economic growth regime for high quality bonds.
Right.
Bond yields start coming down, and it's one of the worst for equities, depending on what type of equity you own.
Right. So we're in the regime where equities won't do as well, or potentially will be negative. Bonds will do better, and now we're moving towards potential recession, which just would magnify that situation, right?
Right. Yeah.
So our recession indicator, little changed, but still positive, and maybe talk through the changes we've seen recently in the data here that brought the probability down somewhat.
Yeah. So markets reached their low point in mid-June, and that's when our recession indicator reached its high point. Because the market-based, survey-based elements of this recession indicator, for example, S&P 500 as a percentage of the 52-week high, the VIX, high-yield bond spreads, those things were very stressed in mid-June, and they have now relaxed somewhat. Good news. We've also had more confirming evidence that we are not in recession right now, because it's highly unlikely to have an Ember quality recession when you add 500,000 jobs, non-farm payrolls. Now, what typically happens is once the economic contraction starts, then those non-farm payroll numbers get revised down later, but still there's enough margin of safety there that it's clear we're not in recession. So what's basically been happening here is the market-based data points have been relaxing, which is good to see, but some of the longer-term and economic-based data points have continued to go the wrong way, as we saw with falling expectations, disappointing data. So net, the outlook for the economy has gotten on the margin worse. The only reason why our recession indicator has come down is because markets have had sort of a bear market rally here.
Right. Okay, let's take some questions. I got one here first to start. So given all the deceleration of economic data, why is the market rallying right now? What does the market know that the economy doesn't know?
Yeah, great question. So the market reacts to rate of change. As we came into June, July, expectations were really, really bad. Everybody was sort of preparing for the worst. So if you go through the different types of investors that are out there in the marketplace, they all basically were the most conservatively, defensively, or short positioned they'd ever been, or at least been in the past year, because the expectation was, hey, we're going to have economic growth slow down and the Fed's going to overhike and we keep having this big inflation shock and it's going to run hot for a long time. Soft landing's never going to happen. And Q2 earnings are going to be ugly. And all that happened was all that data came in bad, but not as bad as feared.
Right.
And the positioning, with 2020 hindsight, it was spring-loaded. A lot of hedge funds, trend-following strategies, vol-following strategies, they all had to re-risk their portfolios just because the data wasn't as bad as feared. And then once the market starts rallying, then everybody takes that as fact.
Right.
And it leads to this narrative that a soft landing is now a high probability event, even though the actual data you would look at to determine if a soft landing is possible is really not that changed.
Yeah.
Yeah.
Yeah. And there's a lot of FOMO, right? In that everyone's got to start chasing. But what we've witnessed, though, is a lot of this rally has been low volume rally. So there's not a lot of conviction, and the VIX just keeps coming down. And when you see momentum shift, you see a lot of volume, and we've not seen that at all. So we don't think this is a real change. This is still a deceleration here.
Yep.
I think we have another question. Audra, I don't have it on my screen, but do you believe inflation has peaked?
You have to get specific, obviously.
Yeah.
If you're talking headline CPI year over year, it most likely has. It most likely has.
But like rents, I think when people care about rents, food, like those things, probably not.
Yeah, you think 1 year out, you look at the food situation with, by all accounts, a very weak planting season, farmers can't get fertilizer. We're already in a bit of a food crisis. That's probably not going to get a whole lot better.
Yeah.
So we are not going to try to call the peak in food prices at all. And then, shelter.
Yeah.
If you're paying rent, we would not sit here and say we're at the peak of that either.
Yeah, I think apparel, like examples of like companies that have inventory problems, you're going to start seeing a lot of inventory be sort of puked up in the marketplace. So you should see prices come down there.
All the stuff you couldn't get during COVID is going to be on sale.
On sale.
Yeah.
Yeah, absolutely. All right, next question. Do we have another one here? Mortgage rates. Oh, this is an interesting one because obviously mortgage rates are tied to what the Fed does, but also to banks' ability to lend and their willingness to lend and the value of real estate. So how does all that play into actual mortgage rates, and where will we see them trend here in the next year?
Yeah. If you sort of just simplify a 30-year fixed rate mortgage into two components, you have one component which is pretty similar to a 30-year Treasury bond yield. And then the other component which is, well, how much extra profit can the bank squeeze? And you look at those two things, well, we think we've seen the high for the year in 30-year bond yields.
Right.
So that part should move sideways or hopefully come down. The other part, though, will probably widen out because, once again, if you look at lending surveys, Fed surveys, and the data that's coming in there, banks, by and large, are tightening and being, much more picky in terms of the loans they give out. And if they are going to make a loan, they are going to demand a higher return because they are very aware of the economic situation and everybody's and the housing market situation. And so they're probably going to demand higher yields from that perspective.
Right. Yeah, if we have a recession, we have mass unemployment, they're going to be less willing to lend, especially if home values are declining.
Right. Loans only as good as the collateral.
That's right. All right. Any other questions here? I don't know if we got any other ones in the queue. Well, week 2.
In the books.
In the books. We appreciate you all tuning in. We'll be back next week with another update, and send us your questions in advance or tune in live and ask us any questions you want. Yeah. Thanks, and have a great week.